Hello and welcome to a demonstration of the lease matrix lease versus own analysis template. You'll find instructions to use this template under the instructions tab, but instead of going through those step by step, what we'll do is just dive right into the inputs tab. The first section allows you to input the global assumptions. So these assumptions would include the report name, who prepared the report, and who the report is for. The next section allows for the time frame and return assumptions. In this instance, we've selected an analysis time frame of 10 years, but you can select up to 15 years of cash flows to analyze. We've kept the default discount rate of 8%, but you can choose any rate that you wish. In this scenario, we don't have any state or local taxes, but we do have a marginal federal tax rate of 35%. If you're not sure about federal tax rates, you can click on this link and be taken to a schedule which displays all the federal tax rates for the United States. The next section is the ownership assumption section. In this section, you'll describe the property under consideration, the address and any other notes, and along with the purchase assumptions. So in this instance, we're looking at a 20,000 square foot building that we're going to offer $3 million for, and we've estimated the land value to be 25% of the total purchase price, but you can set that to any amount. And with any of these formulas, rather than inputting the specific amount, you can also use formulas in the input cells. So in this instance, we've multiplied the purchase price by 25% here to get the $750,000 purchase price. We're going to appreciate this purchase price by 3% annually, and in doing so, we estimate that the sale price in year 10 at the end of our hold period is going to be just over $4 million. We're going to have acquisition or closing costs of 1% of the purchase price, and then assume the cost of sale at disposition of 4%. In addition to these assumptions, we're able to input any financing available at the time of purchase, and in this instance we've selected the loan to value of 70%, an interest rate of 5%, and an amortization period of 25 years. With that information, we've estimated the annual payment to be $147,000 per year. We also input 20% for the current capital gains tax rate, 25% for the depreciation recapture tax rate, and a depreciation life cycle of 39 years. Now this 39 years will use the purchase price less the land value to depreciate the land improvements over this 39-year depreciation cycle. For ownership expenses, we've assumed operating expenses of $5 per rentable square foot and grow those expenses at 3% annually, as well as property taxes at $2 per rentable square foot, and again grow that at 3% annually. In the next section, we have renovations occurring in month 1 of the analysis of $100,000, and we're going to appreciate those improvements over 10 years. The only other assumption area that we're not using for this analysis, but you could use, is if this building is a multi-tenant building or you're getting income from another source. For instance, if you were getting $10,000 per year in other income, you can input that here and then grow it at any inflation rate you wish. But in this instance, we're going to leave these cells blank because the tenant's going to occupy the entire building. So for the lease scenario assumptions, you can analyze the same building or even a different building. In this instance, that's a different building. We've noted here that the asking rent is $14 plus electricity. We've got a similar square footage we're analyzing in 20,000 square feet, a base rental rate of $12. We think we can negotiate the base rent down to $12 and have 3% annual increases. You'll note here with the percentage increases, you can select increases in rentable dollars per rentable square foot if you wish. In this instance, it's going to be percentage increases, and we're going to increase base rent every year beginning in month 13, which is the first month of the second year, and then every 12 months thereafter. If, just as an example, if base rent increased $1 every 3 years, what you'd do is say, okay, dollar increases dollar per square foot, and then every 3 years it'd be the 37th month, and then every 36 months thereafter if you wish. So we're just going to change our assumptions back to what they were, and then move to the next section, which is the tenant expense calculator. In this instance, we're going to have a base rent plus electricity of $3 per square foot. We're going to grow that expense at 3% annually, and there's no expense stop, but if there were, you could enter in whatever the expense stop was. So let's say $3 per square foot expenses and expense stop, then the tenant would just pay the increases over and above this $3. But in this instance, this is a direct expense, so there's no expense stop. Moving to the next section, we've got a rent abatement calculator, which we can select abating either the base rent or the rent and expenses. In this instance, we've abated the base rent for the first 2 months of the lease, and we've abated 100% of that. You could abate 50% of that if that's what the deal terms called for. Additionally, if there was additional base rent abatement, let's say in the second year, let's say month 13 and month 14, let's say 2 months in the second year at 100%, you could just add those lines into the base rent calculator, and we would abate additional months of base rent. The last section is the capital expenditure section. In this section, we've got tenant improvement allowance of $100,000, and we're expending that same amount in our space for build out and things of that nature. Note that we'll offset this tenant improvement allowance with any expenditure. If the two items equal one another, you can elect to leave this field blank. And then we're depreciating these improvements over a 7-year period. Using these assumptions, we generate 3 reports for you. The first report is the results, and this result report basically summarizes the results of all these inputs along with a detailed cash flow, and then discount rates associated with the differential between the lease and the own alternatives, both before and after tax. And then in the next section, we'll make recommendations visually on, okay, if the hold period is greater than 7 years, it means that owning is preferential. So this chart demonstrates that ownership is better if you have a longer than a 7-year time horizon. So in this instance, we have a 10-year time horizon, and you'll notice that these areas here are green because our time horizon is greater than the 7 years. It's actually 10 years. If we were to go back and change this time frame to, let's say, 6 years, you'll notice that the results will turn red. So over your time period, it's not beneficial to own, it's beneficial to lease, and that's what the red area denotes here with the NPV of the differential and IRR of the own versus lease cash flows. And you'll also note here in year 6, it's red, so that means that red means leasing is preferable. So we'll change that back to a 10-year hold period just for the sake of this analysis. So going further down, we've got a couple other charts that make similar recommendations. They should basically all the same thing, say the same thing. But in this instance, you'll see that the own MPV is above the lease MPV in years 7 and beyond, so it's better to own. And The same goes for the internal rate of return is above our threshold of 8%. So you'll see the red line represents the 8%, and then our internal rate of return is above 8% at year, let's say year 10, it's 8.60, and that 8.60 corresponds with what the after-tax cash flow MPV or the MPV and IRR calculate. The other two reports include the ownership cash flows, up to 15 years of detail, along with the lease cash flows. So if your client wants to dig into all the cash flow, they're able to do so. If you want to kind of summarize what the tenant expenses are rather than providing detail, you can click this expand or collapse tab here. Same with the footer information, you're able to collapse that if you want to. And then just as an example, to be able to see what it looks like on a printable version on the layout, you're able to print that information to PDF. And same with the results. We can view what the results look like. This is a 2-page result report here that you're able to print out and provide to your client relatively quickly. So that's a quick overview of our lease versus own analysis spreadsheet. We've got a couple other videos that kind of go into a little bit more detail of the reports and the input section. Again, you're able to find instructions on this template on the instruction tab. It also includes a pros and cons summary, which you can print out for your client if you wish, that kind of notes all the pros and cons of leasing versus owning, like flexibility and mobility, or a disadvantage would be the loss of appreciation, which is sometimes helpful if your client doesn't quite know how to think about leasing versus owning. Thanks so much, and we hope you find this template useful.